Hi, my name is Roger Schluter. The actual video today is doing projections, and projections are really used when you've got a company that's a brand new company. If they haven't been in business for 2 years, their SBA considers them a brand new company. And then regular companies, you give them your past 2 to 3 years financials, but they're still going to want to see projections for a couple of years of how you're going to operate after you get the loan. We're only really looking at on projections. You're really only looking at a profit and loss statement, because that's really what pays the debt service. That's what pays off the loan. So with this, you have to project these amounts on a P&L. And you can look at this one right here. I'm going to have this one up during most of the video. On the P&L, the sales is the most important thing. And a lot of times the sales is the hardest to figure out, where you're going to be at. So you got to hang your hat on something. So it's either got to be your experience in the industry, why you can project these numbers. Maybe, I've been in the business for 20 years and I know we can do this much. Or if you go to a company in a different location that's not a competitor to yours, a lot of times they will give you sales and expense information on that type of company. You can also go to, you can look at like population and say, well, this population is this much. I should be able to get this percent of that using this product or service. So there's many ways you can do it, but you got to hang your hat on something on the sales. Sales and expenses, when you're projecting them, you do have to come up with assumptions. And the assumptions can be hard. And like I said, on the sales assumptions, those are some of the things you can use. On expenses, there's a publication called RMA, and it is actually stands for Risk Management Association. It used to be called Robert Morris. I keep thinking of Robert Morris and Associates. But anyway, what they do is they take a whole bunch of financial statements from a whole bunch of industries and they put them together, and then they look at the expenses. So basically your sales will be 100%, and then it'll show you the expenses of that type of industry and that type of business. It'll show you the expenses, the percent of sales. So once you have sales, expenses can be pretty easy, especially if you look through this Risk Management Association. And it is what it is. It's their statement studies, and their statement studies are the ones that have this information, this expense information, and it's very valuable. SBA banks both look at those statement studies as pretty accurate and pretty good information. Franchises also are a good source. If you got a franchise, a lot of times they'll know exactly what sales and expenses are given a certain population. So they'll know exactly what it can do, given where you are. So that is always good. Franchises, they're not only easier to operate because they have all the systems down, but they're easier to get loans for usually also. Once you have your data filled out on a projection, projections are harder, but once you get your sales, like for the first year, then you want to look at what type of increases you want for following years. So a lot of times if you put an increase of 5%, or if it's a growth industry, 10% a year, you're good. It's believable. For the expenses, you can either, you're going to have variable expenses, you're going to have fixed expenses. A lot of the fixed expenses, like a rent, it would be what you're going to pay for that space. Your electric, you could probably go to the electric company and find out what a typical bill would be for the square feet. Other things, your variable cost would be more the costs that vary with sales, like your cost of a product. Let's say you sell shirts. Well, you're going to have your inventory of shirts, and then you're going to have your markup. But the sales is what's going to determine the cost of that. And so anyway, you never want to project a loss. You never want to project sales or earnings going down. And banks know that. You don't want to just have them go up 50% a year either, because that's unbelievable. Banks do want to see increases in sales, and they do want to see increases in income. They usually will check and make sure the expenses are somewhat stable, somewhat believable. But like I said before, the sales are the main part. And putting your assumptions with all of these, you want to be able to assume the sales are this number because of this and this and this facts. You want to say the expenses of this because, maybe just because that's what the cost is, but maybe because, that's what you project it to be because of other reasons. What you're really doing here on this P&L is you're basically putting your sales and your expenses down, and then what the bank's going to do is they're going to say, okay, what's the debt? What is the cost? Cost per month, cost per year of the new debt. On a brand new company, you're not going to have any projected debt, but if you had or old debt, you'd put it with it. And basically, you're going to look at the annual debt service of that. And what you're going to do is you're going to look at your earnings per year, and then your debt service per year, and then you're going to go ahead and divide your profit, and it should be your cash flow. But normally, when you're doing this, if you're kind of a startup, the only fees that are really non-cash are depreciation and some other non-cash charges, which you're really not going to have. And a lot of times, existing companies, you don't have much on that. So anyway, you want to use your P&L without those non-cash expenses becomes cash flow. And so your cash flow number would be your bottom line, what you're making from this business. And then you want to go ahead and take the debt, take the cash flow and divide it by the debt. And that's going to be your debt service coverage ratio. Now you want your debt service coverage ratio to be 1, because the debt will basically be covered by the profit, but you want it to be over 1. So banks want a 1.2 to 1.3. SBA minimum is probably a 1.1, but the higher the better. I mean, I've seen companies that have the cash flow is their coverage ratio is like 3 or 5 or whatever. Now those the bank would feel a little better about, but they are hanging their head on just that sales, those earnings, to satisfy that debt. Another thing that's brought up in this is that living expenses. You really want to, if you have like a salary based in there, that would be good. But a lot of times you don't. A lot of times you just have, you're just thinking about the business. You're not thinking about your own living expenses. Now, if you have, a significant other that's making money that can pay the bills, then you're good. Or if you, if you have some money saved up, that's gonna get you through that. But really, your projection should be able to cover the debt. And in your projections, if you don't have another source of income, you really need to put some type of a salary in there that you're going to pay your debt with. Banks now, we're probably not going to get into this on this, but a lot of banks will go ahead and do the debt service coverage ratio, and they'll do that. But then they'll also put your personal income and your personal debt in there. So they'll add up the business income, the personal income, and then they'll add up the business debt and the personal debt. And then they'll do another a cash flow or a debt service coverage ratio using the whole thing. These projections are really called a global cash flow, where it brings in the personal and the business. And a lot of banks will look at that too. So yeah, that's one thing that you might just want to go ahead and project yourself so you know what it is. But projections, it's kind of an art. It's not an absolute. So a lot of times when you're doing it, you can show certain things, and it is you're just kind of putting your best foot forward. You're covering it. Most banks are going to know you're not going to show a loss. You're not going to show sales or earnings going down. You're always going to show them going up. So they're kind of aware of this. So I wouldn't really fudge it a whole lot. But you do want to make sure that everything's going up, that everything's going the way you want it to go. This is basically the projection, the way to project. The big thing is assumptions, and the really big thing is sales assumptions and getting the sales out there. Like I said, earnings, when you're using, the RMA, a lot of times, you'll be able to pull out those expenses, and banks and SBA will believe that. But really, you really need to show assumptions on how you got these numbers. And that's the biggest deal. And to really show the assumptions on sales, because sales is the key. You can always come up with your expenses, but sales is the key. And where did you come up with those numbers? So anyway, I'll go ahead and leave it with that. When you're doing a short loan proposal, the projections are a big part of that. And so anyway, I would definitely spend some time on it. But anyway, thank you very much, and I'll see you in the next video. Oh, if you did like this video, if you got some value out of it, please like the video. And if you want to see more content like this, please go ahead and subscribe. And I'll see you in the next video.